Welcome to my channel. I'm the covered call guy, and my goal is to create a $120,000 passive income portfolio using only covered call ETFs. Right now, it yields about $72,000 a year, a little over $6,000 a month, almost $1,400 a week, and almost $200 per day. Legal disclaimer before we start: this content for informational and educational purpose only, and should not be considered financial investment or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be incorrect, inaccurate, or completely wrong. Investing and trading involves significant risk, including possible loss of principal, so please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions, because remember, I am just some random idiot on YouTube and I could be completely wrong. Now, with that out the way, today we talk about WPAY. We are so back, baby! Right, this is from Roundhill WeeklyPay Universe ETF, WPAY. And why do we say we're so back? Because, guys, of today's declared payout. Now, disclosure, I don't own it. I don't own WPAY. However, it is on my watch list. And, however, I did make a video about it previously about the 50% pay cut. Well, we'll get back into the 50% pay raise today. So let's get into it. All right, the December 8th headlines, right? Closing date, it is not December 5th. It should be December 8th. Sorry, typo. 47.43 cents, declared of 53 cents, with an implied annual yield of 58.34% yield, right? The announcement of the 53 cents per share distribution on December 8th has catalyzed a critical debate. And what is that debate? Before you celebrate, hold up, all right? Before we get into the debate, before you celebrate, let's run the run rate math. I want people to understand, especially for those who are new, welcome to the channel, and people who just bought WPAY and end up searching and finding this video. Let's understand the run rate math. You need to understand that the 58.34% is a run rate figure. It is mathematically correct based on the specific payout, this payout, but it is not a guaranteed forward yield. The warning here I'm trying to give you, the fund disclosures explicitly warn you from their quote, copy and paste, distribution rate caused by favorable market conditions may not be sustainable. Please do not treat this as a fixed income promise. I say this in all of the videos, okay? This is a leverage ETF. This is a great tactical tool for experienced investors and or traders. If you're new, what are you doing with WPAY? Legitimate question. I'm just asking. Especially for those under a year, even for those even under 3 years of investing, what are you doing with leverage? Just a question. What are you actually buying? I always do this. I do an introduction, right? For those who are new, who just bought WPAY, who saw it and not sure what they bought. That's another question. Why would you do that? All right, one, it is not an income fund, right? You should not analyze WPAY as a traditional income fund. It is a leverage directional instrument, meaning a tactical tool for you to use, trade in and out, short term. Two, it is a volatility trap. What I mean by that, you are currently navigating a volatility trap. The fund is mechanically forced to maintain a weekly distribution during sector-specific corrections. Three, the erosion risk. We always got to talk about that, right? Specifically in high beta fintech and crypto adjacent equities like this one, WPAY, this necessity risk accelerates your net asset value, NAV erosion. I'm not saying it has erosion. I'm just saying it's leverage, so it can accelerate it. All right? We always ask, where's your money coming from? Another way of saying it in my other videos, where is the yield coming from? How is it paid out? Is it real yield or is it fake yield? Right? My analysis of the regulatory 19A1 notices suggests that the recent payouts are largely estimated as return of capital. What does that mean for you? One, tax deferred. That's great. Yes, this allows for tax deferred income for you. Two, however, faced with reality, it implies the fund is currently distributing your principal back to you rather than an organic profit to meet yield expectations. At the moment, I can't find any information. I can't find information that it says that is making actual profits. I don't think it is right now. Something to be aware of. High risk warning, right? Like I said before and previously, not for buy and hold. All right, I'm advising you, you are advised by me to view WPAY as a high risk, high reward trading tool suitable for bullish trends. Do not view this as a buy and hold income generator. Please do not do that. Even though this is really just my opinion, I don't want anybody to lose money. Leverage, what I always say this, for those who's been a subscriber for a while, what comes after leverage? Liquidate it. All right? Please. Especially those who are new, why would you touch leverage? All right? It's like, why would you use margin? Why would you do this to yourself? If you are new, right, this channel is all about long-term 30, 40, 50, 60-year holds. Okay? We want to buy quality cover call ETFs, income stocks, income ETFs. And then once you're kind of exiting the accumulation phase into consumption phase, right? You're actually using your income, then get into WPAY. There's no need to rush into leverage right now. There's no absolutely, especially if you're building up your portfolio. Why would you want that wild swing plus that wild distribution, right? You might get 53 cents now. Down the road, you might jump up to 80 cents, and then down the road, it might go back to 10, 15 cents, 20 cents, 25 cents, right? You want something consistent, reliable, and kind of guessable. All right, the great decouping of December 2025, right? We're trying to understand the predicament, the last video I made, right? You must contextualize the broader market. A lot of question, I'm getting this comment. Why isn't WPAY near all-time highs when S&P is? This was a comment I got. And you know what that tells me? You don't know what you owned. You didn't know what you owned. All you saw was that other people bought it. It was doing good. It was paying out nice, and you bought it. Right? This frustration identifies a critical macroeconomic divergence that is hurting your portfolio. What are you doing, guy? I'm not bashing you, but it just makes me view. It just lets me know that I hope you're a subscriber. I didn't check, but even if you're not a subscriber, you're just a viewer. You left a comment. I will do my best to reply, and if you want me to make a video on certain things, I'll do it. But a comment left, why isn't WPAY near all-time high when S&P is, right? So, it just lets me know that a lot of people are buying certain things that they don't understand, and it kind of scares me. I don't want you to lose money. This channel, I want all of my viewers, my subscribers, people that support and like the channel, like the video. I want you to make money. Genuinely, I do. The S&P versus the high beta factor, which is WPAY, right? S&P 500, we're talking about them, trading near all-time highs. It is driven by a rotation into capitalization, weighted safety, and diverse mega caps conglomerate. WPAY, when I'm talking to you, yes, I'm pointing fingers at you. If I had a webcam, I'm pointing at you. It acts as a barometer for the high beta factor. Your holdings are not merely tech stocks, they are concentrated bets on volatility, right? For example, Coinbase Coin, Palantir, PLTR, and Robinhood Hood, right? They are concentrated bets, very isolated. It's a funds of funds. You need a risk-on environment. And what do I mean by that? While the S&P creates a new high throughout low volatility compounding, their constitutes require a risk-on environment to outperform. Constitutes just the holdings, right? The funds of funds. The problem with this is that we are in a consolidation phase following Bitcoin's retreat from $126,000. You remember those good times just a few weeks ago when Bitcoin was all-time high? Breaking all-time high after all-time high? Now it's barely touching 90,000? Yeah, that's one of the reasons why. The result, in the absence of these conditions, right, that super crazy bull market, the super jump in volatility, WPAY lacks the defensive balance needs to maintain parity with the broad indexes for you. Are you guys understanding this? The fallacy of index correlation. I get this question too. S&P is doing so well. What is happening with WPAY? Well, for one, Stop using the S&P as your benchmark, because that is an incorrect reference point for you due to the fund's equal weight methodology. A drawdown in smaller capitalization stock like Robinhood has a mathematically equivalent impact on your NAV as a movement in a giant like Nvidia. When you guys are comparing the S&P as the benchmark to WPAY, that just lets me know you have zero idea of what you bought. And I do get upset. Because I don't want you guys to lose, I don't want anybody to lose money, right? That's a terrible feeling. And I was that new investor that FOMO, right? Years ago. I mean, I lost 40, 50, 60, 80 grand. I don't want you guys to be losing money. This channel is all about making money. This channel is all about within 3, 4, 5, hopefully no more than 10 years, all of us will be in a nice beach somewhere on our own yachts, having a yacht party. The generals versus the soldiers. Who's the generals? In the S&P 500, Apple's valuation drowns out noise of mid-cap corrections. And WPAY, your portfolio, yes, I'm pointing at you again, a 15% correction in a single holding is a direct hit to approximately 5 to 6% of your portfolio. When the generals, which is the mega caps, the big boys, hold up the market while the soldiers, high beta tech, retreat, you will inevitably lag behind. And I'm going to the next slide, but there's another reason why a lot of people don't understand how it lags. Right? Mechanics of the machine, understanding what's underneath the hood. Understanding your risk requires a deep dissection of the internal machinery. All I mean is that you own a complex synthetic instrument. It is a fund-of-fund architect. One, that means WPAY tracks the so active Roundhill WeeklyPay Universe Index. 2, it operates as a fund of funds, holding shares of other Roundhill ETF. Specifically, the WeeklyPay single stock ETF. Like I mentioned, Palantir, Tesla, Hood, right? How leverage works for you. WPAY is a 1.2x exposure. The underlying ETF targets 120% exposure to the weekly return of the reference stock using swaps or leverage. Reference stock right here. These 3 and more, whatever it holds. Monthly rebalance. I don't see this a lot, and I don't think people know that WPAY does a monthly rebalance. WPAY rebalance these holdings monthly to an equal weight. This systematically enforces a buy low, sell high discipline. The risk in a market where losers continue to trend downward, you are catching a falling knife. When it rebalances, it doesn't mean they keep the winners. Sometimes they kick out the winners and rebalance more into the losers. I don't think people understand this. If you don't, use your keyboard and go and press backwards and hear me out again. So please understand what you're buying. And comparison WPAY versus ULTY, because in my previous video, I compared WPAY Roundhill's fund manager to ULTY's ULTY manager. This is just a key distinction between the two. This is strictly informational, but I just want to say that WPAY, I said congrats to them, round of applause to Roundhill's fund manager, because instead of paying that 50, 60, 80 cents, they cut it. They did a 50% pay cut to save the NAV. Instead of paying out that high distribution, they went ahead and just said, you know what, for this week, we're just going to pay you a 50% less. So good on them compared to ULTY, right? Roundhill saw what was happening with ULTY and said, hell no, we're not doing this. We're going to go ahead and try to save the NAV as much as possible, as they should, because they are leveraged. It's much easier to go down just as it's much easier to go up. So good on them for noticing that. Good on them for actually seeing what's happening in the ULTY, especially the OT community, and what the shareholders are thinking. So round of applause to WPAY again. WPAY shareholders, this is a good thing. It's a sign of confidence that they kind of understand what needs to be done, right? They're telling you it's gonna hurt for now. We're gonna all suffer the pain, but we will go ahead and gain back the momentum and start back up that payout whenever we can. And as you guys see it from 22, it went from 30 cents back to 52, 53 cents, right? So it's a 22-cent increase. All right, the structural implication, the good news, right? WPAY is structurally superior to ULTY. Again, this is my opinion, in a strong bull market because it is not fighting a capped upside. There is a bad news, right? In a flat or bearish market, both funds face erosion risk. ULTY via capped recovery, and WPAY via leverage decay and return of capital distributions. The volatility drag. I don't think a lot of people understand this either, but I'm going to try to explain it. The use of 1.2x leverage introduces volatility drag. That simply means beta slippage to your returns. While this decay is often overstated in short time frames, it becomes material for you in a choppy market. If WPAY distribute cash weekly while suffering this drag, your hurdle rate for breaking even rises. The underlying assets must appreciate significantly to offset both. The underlying asset must appreciate significantly to offset both. I hope you guys are hearing this loud and clear. This slide has everything to do with this slide because I'm going to explain it. I feel like I need 2 slides because people are not getting it. The math that eats your NAV. Again, this is a hypothetical 2-day scenario. For those who are new, welcome to my channel again. I like doing these scenario. It is hypothetical, it is illustrative, it is my opinion. It is the formula that I've gathered and used. It's not a secret formula. You can find these formula on Google. I don't like telling you what formula is because I am not a professional, and if you use that formula, it could be wrong. So this is my math. Take it or leave it, right? With a grain of salt. Hypothetical 2-day scenario. Day 1, the stock drops 5%. Your fund, which is WPAY, is 1.2x leverage, drops 6%. The underlying stock, which started at $100, right? I'm just saying WPAY is $100. It's just a nice rounded number. Day 2, stock rises 5.26%, back to break even. WPAY at 1.2x rises 6.31%. However, WPAY is still at 99.93%. Why? This is called leverage decay or volatility drag, right? We're assuming the underlying stock starts at 100. Yes, this just assume it because I like that $100. A rounder number is easier to look at, right? So the fund WPAY is leverage, right? Target at 1.2x the daily move of the stock. We're assuming a 5% drop, so $100 to $95. The fund, right? The math behind that is 1.2x times 5%. We get 6%. That means $100 went down to $94. Day 2, the stock rises just enough to get back to 100, right? From $95 to $95 to 100, right? We're talking about the underlying. So 95 divided by 100 divided by 95 minus 1, give or take, is about 5.26%. The fund WPAY 1.2 times 5.26, give or take, it's about 6.3%, right? So from $94, which is WPAY, times 1.06 equals about 99.93%. Right? The result, even if the underlying stock is back to break even at 100, the leverage fund is still down 0.0% at 99.93%. That is because The WPAY re-leverages each day off the new base. Okay, that tiny shortfall is what I'm calling, my title here, the math eats your NAV, right? Over many volatile up and down days, these small losses compounds over weeks in your portfolio. This is the leverage decay or volatility drag here. A lot of people don't see that, just like how people don't see the expense ratio eating away at the profits, at the gains. So little minor things people don't realize. The payout paradox, right? December 8th. The skepticism regarding the payout is mathematically grounded. What I mean by this is, unless I'm wrong, the payout you receive is 53 cents. The price gain from the previous week was about 22 cents, right? 22 cents gain. I'm just saying the payout is greater than appreciation means erosion. I could be wrong. If you think I'm wrong, let me know why. This is just how I see it. This is how as easy I could break it, as easy as I could understand and break it down. And this is just the distribution history, right? I just want to put it out there and say, right, November 17th from 40, 45, 35, 58. And it's just, you start to see the swings in things. All right, modeling your volatility trap, right? So I projected the impact on your NAV over 4 weeks, okay? Assuming a 53-cent payout. Scenario A, the chop. I'm going to say the NAV declines. Yield paid from principal. Scenario B, correction. Severe erosion. Payout digs a deeper hole. Scenario C, the rally. Obviously, this is a bullish funds of fund, positive return. The only sustainable path. We need the market to pump. We need the underlying that they hold to pump. This is the only way. The engines of volatility. This is how I kind of broke it up. I could be wrong. So this is a give or take kind of. This is my guesstimate, right? The engines of volatility behind WPAY. I think number one is the crypto anchor, right, at about 11% weight. Coinbase and Robinhood in a 1.2x wrapper. These act as a dead weight, dragging you down despite tech rallies elsewhere. And then we have momentum play, which is 6% of the weight. Palantir, insider selling from ARK Invest suggests caution, leading to sideways actions that generate little organic yield for you. I haven't found anything that they have been paying organic payouts yet, so just beware of that. Then we have the stabilizers, right? It's about another 6% of the weight. We have Meta, Broadcom, right? Their equal weighting is insufficient to offset the steep drops in your crypto and fintech basket. This is where we're not seeing the NAV go up. So when you ask why, right here. Unless I'm wrong, you can prove me wrong, please. Because this is how I'm seeing it. I think this is what's kind of dragging the NAV. Underlying holding context. This is just another kind of scenario to see it. I'm just made another slide for it. Kind of easier if you understand it easier this way, right? We have Hood from Robinhood, the weight about 6%. In a trend, which is a correction, drops 14%. Impact on you, high drag. We have Coinbase, the weight is about 5.43%. In a bear market, minus 30%. Impact on you, severe drag. Palantir, about 5.75% of the weight. The trend is consolidation. Impact on you, neutral drag. And then Tesla is about 5.70%. The trend right now is that Tesla is pretty volatile. Impact on you, volatility drag. So all of that is hurting. All of this is not good, right? We don't want to see any of this. Impact on you, we want all of this to be green, shooting upwards. All right, last slide. This is my verdict. I don't think this is a yield trap just yet. It is not a yield trap in a sense of ULTY, where the upside is completely capped. WPAY can recover for you if the market rips higher. Is it a volatility trap? It is a volatility trap if the market chops sideways. The combination of leverage, drag, and return on capital payouts will erode your NAV over time. And just caution, guys. I don't want you guys to lose money, so just think about this right now. Okay? For the seasoned investors, of course. If you're new or you're completely a newbie, I don't even know what you're doing with WPAY because I mean, unless you're completely retired and you already have a core position and you just have WPAY for fun and you're new, then that's kind of crazy actually. But yeah, that's my verdict. Is this the sorry about that? It's not the last slide. I thought it was. The next slide is the last slide. Is this right for you? I'm gonna say avoid if you are an income investor seeking preservation of capital. The 58% unit is a variable and currently funded by your principal. I'm not seeing any actual profits, so that could be a warning sign. Consider it if you are a tactical trader who believes a broad, aggressive risk on rally, such as crypto and tech, plus growth is imminent. Right? That offers you a diverse leverage way to play that thesis. Oh, never mind. I did have more. Ha! Actionable advice for you. This is just my opinion, right? This the disparity between the price appreciation of 22 cents and the payout of 53 cents. To me, I want to say that's a warning signal. If the NAV is not rising, the payout is borrowing from your future, right? Verify the trend of the underlying high beta assets, not the S&P 500, before you commit capital. And you shouldn't be committing capital if you're new. Thanks for watching, guys. Subscribe, comment, like. Thanks for watching. I hope this was educational and informative. I hope I was wrong, or I mean right, but I could be wrong. I hope I'm wrong. Maybe this would be in a better light for you, right? So, let me know what you guys think, cause this is how I'm seeing it. This is how I'm understanding it. So I'm just trying to break it down for you. Catch you guys on next. Thanks for watching. Stay tuned.